Greetings, Jonathan Camarda with your mid-month macro update. Last episode, we talked about the February weakness and the market coming down, and it has definitely occurred thus far. So let's break it down from the macroeconomic right down to the more granular. Interest rates, they've certainly come down, right? The yield curve is uninverted, folks, in a big way. The 2-year is about 4% yield, 10 about 4.3, 20 years about 4.6, all significantly lower than where they started the year. The dollar, of course, you'd expect that to come with it, has been very weak versus the euro, the pound, the yen, significantly, to a lesser extent, the CAD, Australian dollar, and New Zealand dollar. Now, of course, the yen, the safe currency position there, liquidity, safe currency out there, the lighthouse, if you will, is significantly outperforming the pound, which is significantly outperforming the dollar. Just to give you a point of reference there. Now, when we start to look at moving the chairs, best performing, equity markets, no surprise, right? We've had the Hang Seng, China, and then of course Europe, and especially we've seen more recently the German DAX. And so in some of your strategies, you'll notice that we have certainly been positioning into those more attractive global markets. It's been a minute, as the kids say, since those have been outperformers. On the domestic side, low volatility, go figure, outperforming momentum. Sector-wise, healthcare, utilities, and energy stocks. The more boring and safe sectors have been definitely stealing the show. And as we talked about last time, technologies and your discretionaries and as such, certainly holding up the bottom, of the food chain, so to speak. So where do we see things right now? Well, we start to look at the National Association of Active Investment Managers, which we reference every now and then here. They've taken it down over 20 percentage points to about 68% equity exposure on the long side. And you'll see in some of your more satellite tactical strategies that I individually run, for example, Global Macro Tactical, down to about 68%. We don't follow them, but I guess great minds. And then, of course, Velocity Raptor, which is more bootstrapped on top of Global Macro, down as well. All Stars, which is more prevalent across most of, that's our NASDAQ strategy, 5 to 10 stocks, that has come down to about 57% equity exposure, as it's very tactical as well. So although very aggressive, it can get defensive in down markets as well. So you'll notice across your overall allocations, and of course your individual situation discussed with your personal wealth advisor, as I do with my clients, on how that actually is affected not only by the markets, but more importantly, your financial situation and perhaps income needs. So now, where do we see things? Well, what we're seeing right now is the S&P, the Dow, and the NASDAQ all below their 200-day moving averages. So while many talking heads, all right, on TV, talk about this is a normal garden variety 10% pullback, and it may be. Again, you must have a GPS, just like when you're driving, to know where you're headed. And so right now, when the market's below the 250-day moving average, with the 50-day moving average curling down like a melting ice cream cone under the July sun, you have to be cognizant of that. So a rally like Friday, which was nice, again, should be taken as more of a mean reversion or a bounce back within a downward trending market. For clients that are more conservative or that we have pulled back the equity exposure, you don't want to get lured in by those up days, because some of the most ferocious up days happen during bear markets, which we're not calling here. We're just saying we got that miner's helmet on. I guess we don't need the old Rand McNally anymore. We got the AI-generated GPS or something. Anyone even use Garmin's anymore? So that's kind of what we're seeing right now. And then the Fed, they're unlikely to move here in March, even with some of this weakness that we've seen. Again, economic data is mixed, but certainly yields coming down, inflation forecasts coming down. But they're unlikely to move here, although the overall annual rate decreases have been bumped up by prognosticators, from 2 to 3. So again, we shall see whether that is actually a golden pill or potentially a bad omen. So again, just like I think this month, I'm not a huge basketball fan, but I think it's college basketball where more people actually watch than during the regular season. Certainly more meaningful games. They call it March Madness. Well, for the markets, it's market madness. So as always, whether you're down here in the south as things warm up or up north, just be patient, folks. I grew up there, so I know it's a little slower. Stay frosty. For us, we don't sleep. We'll stay eternally vigilant. And as always, pleasure to serve.